AstraZeneca shares fell on Friday, closing near 13,942p. On the same day, the European Medicines Agency's Committee for Medicinal Products for Human Use recommended Datroway for first-line treatment in metastatic triple-negative breast cancer. The contradiction sits in plain view: a landmark clinical endorsement, and the stock declines. The explanation does not lie in the clinical data. It lies in the valuation framework the market is using to translate that data into a price signal. Datroway's TROPION-Breast02 result was not marginal. In patients with unresectable or metastatic TNBC who were not candidates for PD-L1 immunotherapy, the drug extended median overall survival to 23.7 months versus 18.7 months for chemotherapy, a 5.0-month gain. It reduced the risk of disease progression or death by 43%. The objective response rate was 62.5% against 29.3% for chemotherapy. If approved by the European Commission, Datroway would be the first TROP2-directed antibody-drug conjugate with a demonstrated overall survival benefit in first-line TNBC in the EU. Today, only 15% of patients with metastatic TNBC survive beyond 5 years. The addressable population for this specific indication, TNBC patients ineligible for immunotherapy, is narrow but carries high unmet need and high drug pricing power. The clinical argument for commercial value is clear. Yet the stock did not respond. The reason is that the market's difficulty with AstraZeneca today is not about this approval. It is about whether the current price already contains it. The pool carries two distinct readings of AstraZeneca's value, drawn from the same company, the same pipeline, and the same trading session. One finds the stock 39% below fair value. The other finds it expensive relative to peers. Neither is wrong within its own frame, and that is the problem. The discounted cash flow argument rests on AstraZeneca's trajectory: annual revenue of approximately $60 billion, net income of $10.4 billion, and a pipeline that management believes can generate $10 billion or more in peak risk-adjusted revenue from new medicines alone. Using a two-stage free cash flow to equity model, one analysis places intrinsic value at roughly £231.15 per share, against a current price near £140. The implication is a discount of over 39%. By this logic, today's Datroway recommendation is not just positive news, it is confirmation that the pipeline the model prices is executing on schedule. The earnings multiple argument runs in the opposite direction. AstraZeneca's current PE of approximately 27.7x sits above the European pharmaceuticals industry average of 20.8x and well above a peer average of 11.3x. At that premium, the stock is not cheap unless the pipeline delivers at the upper end of forecasts, continuously for years. A positive CHMP opinion for one indication, in a disease segment whose commercial revenues are still years away from full recognition, is absorbed into a share price that is already priced for optimism. When expectations are embedded at this level, good news does not move the stock upward. It prevents a decline that would have occurred without it. This is the hidden assumption the approval optimists require, that 27.7 times earnings is a fair multiple for a company whose next meaningful revenue inflection sits in H2 2026 at the earliest, and whose current price reflects every pipeline success the market can currently see. If that assumption holds, the Datroway news is a repricing catalyst. If it does not, the approval merely confirms what was already in the price. The tension between these reads is not resolvable from today's articles. It requires a forward event. The valuation disagreement will not be settled by the Datroway approval. It will be settled by CARDIO-TTRansform, the Phase 3 study of eplontersen, YMCA, in transthyretin amyloidosis of the heart, with data due in the second half of 2026. Jefferies, which rates AstraZeneca a buy with an 18,000p target, approximately 30% above Friday's close, frames the CARDIO-TTRansform readout as the single event that most moves the stock's risk-adjusted value. A positive result, the broker argues, could de-risk approximately $5 billion in future sales while adding a low single-digit percentage to net present value. The transthyretin amyloidosis market is projected to reach approximately $18 billion by 2030, driven by earlier diagnosis and a structural shift toward disease-modifying therapies in a condition that remains widely underdiagnosed. Eplontersen is an RNA silencing agent being tested against a large patient population, both alone and in combination with existing stabilizer therapies. Jefferies cites the breadth of the trial design as a structural advantage. The drug is positioned to succeed in multiple subpopulations within ATTR-CM, rather than in a single defined cohort. A favorable outcome does not just open a new indication, it validates a multi-mechanism franchise in cardiovascular rare disease, the sector where AstraZeneca currently lacks the strong cash-generating position it holds in oncology and respiratory. Here is the check the PE bears require. At 27.7 times earnings, AstraZeneca's current price is defensible only if CARDIO-TTRansform or comparable late-stage catalysts deliver. A negative ATTR-CM readout does not merely remove $5 billion from a model, it challenges the premium multiple's entire premise. Jefferies already acknowledges that AstraZeneca must de-risk roughly $12.5 billion in incremental revenue by 2034 to sustain its projected top-line growth of around 3% annually. CARDIO-TTRansform is one of a small number of trials that can move that number materially. For a holder of AZN, the monitoring variable is not the European Commission's formal approval of Datroway. That is a formality given the CHMP positive opinion, and it is already priced. The monitoring variable is whether the ATTR-CM data arrives in the first or second half of 2026, and whether it validates the broker's risk-adjusted revenue assumptions. A holder who bought on pipeline conviction watches CARDIO-TTRansform, not today's oncology headlines. For a watcher considering entry on the back of today's TNBC recommendation, the entry logic requires confidence that the DCF view, not the PE view, is the correct frame. That confidence is not available from today's pool. The position to take is observe and wait for the ATTR-CM data to establish which valuation model the market will use to reprice the stock. A confirmed positive readout would be the first moment the DCF argument gains market visible support. Until then, the approval that did not lift the stock on the day it was announced is the market telling holders and watchers the same thing. The debate is not closed. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.